Okay guys, welcome to it. This is the finance and investment class example. Let's get straight into the class example. Let's analyze it and see what we can learn. Okay, so you are the audit senior. Audit senior means you're giving guidance of Fly By Night Pty Limited. So it's a private company, which is a small passenger airline. Okay, already we know passenger airlines are under heavy pressure, number one because of COVID, but even before COVID there had been a number of bankruptcies in the airline industry. So we know that they're under significant pressure for things like earnings management, which is where you manipulate the profit to smooth out earnings, etc. So we need to be very careful of identifying things like earnings management. And just by the way, provisions is one of the key places for earnings management. Okay, so discretionary, what the word is, discretionary accruals that management has control over, and provisions is one of them. That's the key area for earnings management. Okay, so the next is the year end is 30th September 2020. Okay, cool. You are auditing the non-account liabilities. The following information was provided to you by the client. Okay, so provision balance comprises the following. Okay, so we've got provisions for management bonuses. Note 1, it says managers are entitled to a bonus, right? Based on the criteria which is determined a year in advance at the annual review of the performance review. Okay, annual performance review, right? Okay, and then it says the next one is provision for aircraft maintenance. Okay, that sort of seems like it should be there. We should be having a provision for aircraft maintenance. So it says 320,000 of this balance relates to the contract that was entered into earlier in the year with CC Airborne or Airborne CC for the maintenance of fly-by-night helicopters for a period of 2 years. Okay, so this provision is for 2 years. Okay. The remainder of the balance relates to the entry that is recorded on the 30th of September 2020. Okay, so on the last day of the year, they recorded something here, right? And it says for maintenance expenditure incurred, not yet paid. Maintenance expenditure incurred, not yet paid. Should that not be an accrual instead of a provision? But you see, the issue with an accrual, if you put this through an accrual, you have to have an invoice backing it up, right? So you guys know that when you study accruals in accounting, it'll say accruals, the timing is definite, whereas with provisions, the timing is not definite. So as a result, you can raise a provision without an invoice, but you can't raise an accrual without an invoice. You have to have an invoice for an accrual. Yeah, so for example, accrued expenses, you must have an invoice. So this seems like earnings management, right? So this seems like they had a lot of profit in 2020. They want to keep some behind for 2021 to make it look like they made an even profit across the both years. And so they just sort of hid this amount in provisions, and next year they'll release it out. And also the date, it's happened on the last day of the year, which is concerning. Okay, so let's go to the whiteboard and see what we can make of this. Okay guys, so welcome to the whiteboard. The required for this specific question is talking to us trying to create audit procedures for fly-by-night, particularly focusing on the provisions balance. So let's just have a quick recap of what we need to focus on when we're talking about provisions. Remember, completeness is a risk. We want to make sure that we address completeness. We want to make sure that obligation is there because of that idea of present obligation. We want to make sure that we cover that, and we want to be very careful to understand exactly what we're talking about. So let's get started. We need to have a general section. So we're going to start off with actually having a general section for procedures, just basically dealing with provisions. One of the very first things you're going to notice that we need to do with provisions, and you're going to see this with all of your audit procedures, we want to get a complete breakdown of these amounts as it is seen in the GL. So we're going to obtain a schedule that breaks down the provisions balance right from the GL into its various components. This will allow us to audit the provisions balance in detail and to understand the different amounts that compose the balance. Now, after having obtained that, and you can see where I'm going with this, we're going to cast and cross-cast these balances to make sure that they actually do add up to the balance that we find in the GL. And then we want to move from the GL into the financial statements. So we're tracing the schedule, we're tracing it right from the schedule into the general ledger, into the financial statements. So that's the key. We have to arrive back at the financial statements because we're auditing the financial statements. So we want to get back to the financial statements. So we got the schedule, casted it, cross-casted it, traced it to the financial statements. Then we're going to want to understand exactly what management includes in their management representation letter. So that letter is a letter that we obtain from management in which they say, listen, certain things the auditor can't actually test, so we will give them assurance that we've looked at it. And it's not a very strong type of audit evidence, but it does give the auditor some sort of barrier, particularly when it comes to auditor's liability. It gives them some sort of barrier that they can fall back on. So we're going to ask for a management representation letter, specifically dealing with assertions that relate to liabilities. And when we're talking about liabilities, we're talking here in this scenario specifically about the provisions balance. So we want them to focus on those assertions that are difficult for us to test. Obviously, you know, completeness is going to be an issue when we're talking about this type of balance. Also, because we're dealing with an accounting estimate, you know that the risk is much higher on an accounting estimate. And so as a result, we want to gain some sort of assurance on the balance from that perspective. So we really want to understand and want to work out what exactly is coming out of the management rep letter that we can use. We're looking for completeness, and in fact we would want to tell management that in their letter they must have completeness. Now let me just take a few seconds while we're talking about management rep letters and just explain what is one of the main problems that I notice when marking scripts. Students don't apply themselves to the management rep letter. They often would just write down, obtain a management rep letter. That is wrong, because you are not indicating what assertion the management rep letter needs to cover. And you will see here in the example that we have on the screen that it needs to be clearly indicated the assertions that we're trying to cover. And completeness is going to be the most important one, right? So completeness is the most important one, but we have to also mention the other assertions. So if you're writing management rep letter as a response down, please ensure that you fully explain and expound what exactly we are looking for. So please explain that you're looking for existence, valuation, and completion. Completeness, at least. You cannot just expect the marker to know the assertions you're looking for. And if the assertions are not there, your procedure is incorrect, incomplete, and should be marked wrong. Now, in the past, we haven't, because the students needed the marks, desperately needed the marks. So, but at a board level, at a CTA and a board level, you're going to get marked down for just putting a one-liner, obtain a management rep letter. It's not going to cut it. And more importantly, when you're out in practice, then you're really going to struggle, because then if you're an auditor, you're going to get sued. The next thing we'd want to cover and we want to talk about is our analytical procedures. So provisions is something that should be relatable from year in and year out. So from last year to this year, we should be able to identify what are the changes, and when we doing that, we can then look and see if there's anything that's changed materially, any ideas or any provisions that have been left out, anything that we want to focus on. So we can do that by looking at our provisions from last year, comparing them, looking at the ratios, looking at the changes in other types of balances that we know give rise to provisions, things such as rehabilitation, things such as operations. So those are the things we look at and say, okay, these are the driving factors that give rise to particular particular provisions, and so is there any merit for the level that the provisions are currently at. So moving swiftly along then, let's get down to the provision for the management bonuses. So you've got to remember that this amount sitting here in provisions looks a bit suspect, because they're making it seem as if, we don't know whether we're going to be paying out these bonuses. And that should not be the case. If they're performance bonuses, they're based on performance. Performance is inherently, by its nature, it is something that has happened in the past, right? So you can't offer someone a bonus for performance that has not been performed, or for something that has not been done. So if the performance has actually happened, it's already in the past. So we want to now analyze this and try and understand, why is management putting this under provisions, because it doesn't look like it needs to be under provisions. So we're going to start off our procedures really tackling it like an accrual, right? And so what do we do for an accrual? We go to the source documentation. Now, under normal circumstances, the source documentation might be an invoice. Here, though, it's going to be the genesis of the provision is going to be minutes of meetings, particularly the remuneration committee meetings. So we want to obtain those minutes and identify where in those minutes did it say that the managers are actually entitled to a performance bonus. So once we identify that, then we can dig down. So now that we've got approval from board level, we can dig down into the performance review level, right? And so we dig down into the performance review level to try and understand, okay, so based on last year's performance reviews, what were the targets set for the various managers, right? And it's not necessarily always going to be the same for all managers. So we need to be able to keep a track of that. Okay, this manager was allocated this performance target and this manager a different one, right? So we're going to be trying to prepare that type of Excel spreadsheet where each of the managers are there and their performance bonuses are there. We then look at the method of how the performance bonus is calculated. So is it a percentage of the sales made? Is it a percentage of the branch's profit? Whatever. So we going to look at that, and once we identify how it was recalculated, the first thing we're going to do is try and recalculate it, right? So we want to understand the method and recalculate it, and then identify if this payment was approved. So I'm assuming that this payment might have been approved by the directors of the board, but it could also have been approved or needed to be approved by someone else, right? So it depends on the amount, but I'm assuming it's probably the board. So we go to the board minutes of meetings, look for approval. If it's not the directors that approved it, maybe it's the CFO, then we're going to look for signatures, right? So either signature or approval by way of minutes. we can then agree the actual names that need to be paid out after after we've done our calculations, right? We agree the amount of names that we have come up with. So based on the calculations we've done, we think these managers actually need a bonus, and we compare that to what is actually being paid out or what will be paid out, and that will give us a better idea of what we're looking for. So we want to be able to do that comparison, that reworking and understanding of what exactly needs to be paid. We can then obviously look at the records to see if any payments were made in the past, right? So we're trying to identify if the payments were already paid out. And if they were already paid out, we need to make sure that they're no more appearing under the provision, right? Because that's already been paid out, doesn't need to be provided for. And then obviously re-perform all calculations, like I said, based on the criteria that we had identified. It's also important to note that when we're inspecting the bank statement, we're going to be looking at the bank statement to try and understand if after the year end these amounts were paid. If these amounts were paid after the year end, then it's clear that before year end it would have been logical for the client to actually have identified and known that this payment needs to be made. So there isn't an uncertainty around timing. Because there's no uncertainty around timing, it needs to be removed and placed under accruals. Okay? Because there's a little to no uncertainty, it needs to be removed and replaced and put under accruals. So that's what we want to do. Like I just said, now if the criteria is met and payments have not gone out, okay, so if the criteria is met but payments have not gone out before year end, it is clear that this is an accrual and we are not dealing with a provision, because there isn't really uncertainty around the payment time. So we need to be careful and watch for that. Okay, so if obviously before the year end the criteria is met, we need to make sure that it's moved to accruals. But what about if the criteria is not met? So what say we're dealing with a situation where the criteria hasn't yet been met, but the amount is appearing in the provision because management is saying that the timing of the amount or the timing of this payment is not certain. Does that make sense to us? Okay. I think we first need to understand, when does the performance bonus cycle run from? What is the beginning and what is the end of the performance bonus cycle? In this question, or in this answer, we will assume that the cycle runs the same as the year end. And that is a valid and reasonable assumption, because if it were to run outside of the year end or on a different time frame, it would make little evidence, and it doesn't make sense, because management would want to push the managers to meet their deadlines before the year end comes through, so that they can get all the sales in and have a good financial statement. Whereas if the performance bonus cycle runs differently to the financial year end, they'll be pushing in the middle of the year and creating a lot of sales in the middle of the year, whereas we actually want as many sales as possible to get crammed into the end of the year. So I'll assume that it would be running from the beginning of the financial year to the end of the financial year. So if at the end of the financial year the criteria has not been met, it's clear that the managers have no more time to actually meet this criteria, and therefore this provision will never be paid. Okay, and as a result, because of the fact that this provision will not be paid, in the future, it needs to then be removed. Does that make sense to you guys? Right? So it needs to be removed, because the payment about the bonus is not uncertain. We know that it will not be paid. So it needs to be scrapped, written down. So that's the first part we've dealt with. Let's turn our attention to the provisions for the maintenance in the aircraft. Now, while reading the question, you'd remember that we said, this provision looks like it's supposed to be here. It looks like a good provision. Let's try and analyze that and come to a conclusion as to whether this provision actually should be here, because there were some things that were a bit confusing about this provision. The first is that there seems to be a contract, okay? And as our first port of call, we want to take our provisions schedule, which we obtained, remember, under the general section, and then look into particularly that contract to identify if there's that present obligation, right? And more importantly, we want to try and understand, why are we saying that the payment or the outflow of cash is not certain? Okay, so we're looking for two things. We're looking for the present obligation, and we're looking for the outflow not being certain. What about this transaction? And that's why we're looking at the contracts. You can also look at the invoices, but mainly the contracts. So what about it is uncertain, is the question. Because the way one would understand it is, if the work is completed, then the work needs to be paid. So there isn't really anything uncertain about that. Okay? Now, while we have these invoices on hand, maybe we should consider doing some other tests with the invoices. Maybe we should consider looking at the invoices to gather other types of data. For example, we can obtain the invoices and we can confirm that the client or the recipient, as per the invoice, is our client, fly by night. Right? What type of assertion will that be looking at? What assertion are we trying to get at with that test? We are trying to look for obligation. Is our client obligated to make this payment? The next thing we can look for is to try and understand the dates on which the invoices have been issued. What are the dates around the transactions that have taken place? How is that going to help us? Well, we're going to start looking and understanding and looking for cutoff. We now want to get to the crux of the matter and understand why there is this uncertainty on management's behalf. Why is management believing that the payment of the maintenance is uncertain? Now, management may rightly have allocated it to a provision, and that's why I'm stressing the fact that we need to think about this. Sometimes you've got strange contracts with contingent clause, etc. Particularly in the airline industry is notorious for those types of clause. So we want to make sure that we understand the agreement and the invoices to identify if there is some uncertainty arising from the payment of the maintenance. Likely, I am going to stick my neck out here and say, likely there's not going to be that uncertainty. So we're not going to find that uncertainty. And if we don't find the uncertainty, then we are not dealing with a provision. What are we dealing with? We're dealing with an accrual. So we're going to ask our client to move that into accruals. Let's move on to the accuracy, valuation, and allocation then. So we want to, I want to just pay a little bit of attention to the layout. Notice how we've laid out our work. We spaced it out nicely to make sure that it's easy for the marker to identify. Everything is numbered. Everything is clearly delineated so that the marker can quickly spot our marks and allocate them, move on to the next part of our assessment. So that type of writing with the marker in mind is definitely going to get you more marks, right? So writing with the marker in mind definitely will get you more marks. So back to accuracy, valuation, and allocation. We want to trace all of the amounts that need to be paid to invoices. We want to try and understand that or confirm that the invoices there are actually appearing on our schedule. And the next thing we want to look for and understand is that the maintenance contracts, we want to make sure that the performance of the 320,000 actually relates to our current financial year and is not dealing with another financial year, which can sometimes happen. We want to make sure that if we're dealing with the entire contract at 320,000, there is an apportionment that has been done for our current financial year, because there's a risk that this has not been apportioned and the whole 320 has been lumped up into our provision. So we want to clean that out and make sure that if the 320 relates to our financial year, if it doesn't and it relates to the full thing, then we must actually apportion it. Okay, so on to the next page then. We going to go, and on this page we going to want to look at completeness. So this again is the main event. Okay, so we want to get this one right. Completeness. So we're going to inspect the financial statements of the company. We want to inspect the director's minutes of meetings. Now, when I say financial statements, I should actually have said their prior financial statements, including the director's minutes of meetings, to identify any sort of provisions that had come up in the past that maybe have vanished. Okay, so we want to identify if we compare last year's financial statements to this year's provisions balance, what are the changes? Why have they changed? We'll inquire from management why they have changed and if there was a valid need to remove them from the financial statement. So that's what we're trying to get at, is to understand if there was a valid need to remove specific items from the financial statements. The next thing that we're going to try and do is agree the schedule and identify from the minutes of meetings, once we've reviewed the minutes of meetings, if all the items that were spoken about in the director's minutes of meetings or in the risk register agree back to the schedule, right? So maybe you guys can add that onto your actual solution. We must look at things like the risk register and look at things like the director's minutes of meetings to make sure that they've captured everything correctly. So if an airplane is gone in for maintenance, it's easy to identify because the airplane will not be flying, right? So let's have a look at the flight schedules of the different aircrafts and identify when they haven't been flying. Okay, so when haven't the airplanes been flying? That will tell us when they were in maintenance. We can obviously go back to the maintenance logs of individual aircraft and identify in those individual logs when these airplanes went for maintenance last. We can go one further step and try and agree the maintenance logs which we've spotted, we can agree them back to an invoice that we've obtained from Airborne CC. Okay, so now notice how we're going from right outside the accounting record. So we're going right to the right to the source, which is the aircraft. We're tracing the maintenance back from the aircraft back into the accounting records. Okay, so remember, with completeness, the direction is important. With completeness, we need to go from the flow or from the source into the records. Remember when we did inventory cycle, we said we must go from the flow to the records for completeness, and for existence, from the records, from the accounting records to the flow. In the same way, we're going to go from the aircraft to the maintenance account here. So we go from the logs, identify what exactly maintenance happened on specific aircraft, trace the maintenance that happened per the maintenance logs of the aircraft back to invoices, individual invoices that we obtained from Airborne or the supplier, and that will give us now completeness to make sure that those specific invoices have actually been recorded, into the financial statements. Okay. So the next thing we can do is we can inspect the bank statements, particularly post year end. And what we're attempting to do by inspecting the bank statements at a post year end period is, for us, we want to understand if there were payments made in relation to the maintenance liability or the maintenance provision that has been raised here. Okay, so we want to consider whether the timing, we know that there's a present obligation, want to consider whether the timing is uncertain. Because if management knew that something needed to be paid, on the invoice they would have a pay by date, pay or due by date, then management can't really say that, listen, this was something that was uncertain or we didn't know about it. No, it's not going to work out. So we really want to analyze that and make sure that management understood, or maybe didn't understand, that this was a certain payment. It's very unlikely that something like maintenance, particularly if there's a contract, like something like maintenance, is going to have an uncertain payment period. Okay. Now, when we're dealing with the other portion of the maintenance that's not in the contract, that is a little bit more tricky, because I would hazard a guess that that is a type of earnings management. And so we want to analyze what these amounts relate to, and we want a complete breakdown of them. And if they are not uncertain, and if they are not a present obligation, they have to be reversed. Okay? So we need to be hard on our clients for that one. We want to focus on that. Back to completeness, one of the main ways that we can identify if there are any outstanding liabilities or provisions is to chat to the lawyers. The auditors and the lawyers must chat so that the auditor is able to identify if there's anything that should be in the financial statements that are not there. So we're going to chat to the lawyers and identify what exactly are the outstanding claims, the outstanding litigations, the outstanding attorneys' actions that this specific client is involved in. Once we are able to identify, what exactly are the legal issues that this client is involved in, we can then request the lawyers to create for us a probability assessment, which is basically where the lawyer indicates to us what exactly is the probability of our client being successful in this legal matter. And if they are not successful, how much are they going to pay? what is the probability of that happening, and then we would basically go on a weighted average of probabilities and take the amount that is most likely to be paid. So basically we look at the different probabilities, identify which is most likely to happen, we'd weight the average of the probabilities, and then we can take the average of that amount, and that would be used in our, or should be used in the financial statements. Now the client should have done this, but if they didn't, then let's try and rework it and recheck that this has happened. So we want to go with the most likely outcome when we assessing this risk. So the next thing we can do to try and identify any provisions that are not captured in this balance is if we start to look at the minutes of meetings, particularly the minutes of meetings of the directors. And when I say minutes of meetings, we must include the risk committee. If there is a risk committee, we must include the risk register. And we know all companies who are applying King 4 need to have a risk register. So this is a private company, but we'll just for your information, they should have a risk register. We want to identify these amounts and these possible risks that are arising out of the risk register and whether they have been included here. So that's what we want to do. Look at what the risks were as per the minutes of meetings and see if they have been included here. If they haven't, then we're going to ask them to raise it. And then obviously the one that we've already sort of touched on, but looking at the prior year working papers, including the prior year financial statements, to make sure that nothing needs to be carried forward to the current year in relation to the provisions. And then we also want to audit the prior year provisions to make sure that they all have been adequately satisfied. We do that by inquiring of management their understanding as to why specific provisions have fallen away or why they are no more required by this entity. And so yes, we can investigate and assess based on that. Now guys, so that will be the end of this particular it's not a tutorial, class example, but I want to now focus and take a few seconds where we look at how are we going to think outside the box and the auditing box or the audit box. How are we going to think outside the box? So what we've dealt with in today's class example is we've been analyzing and looking at a accounting estimate. We're attempting to test an accounting estimate. Now, accounting estimates are notoriously difficult to test, okay, because they vary in nature and they're heavily judgmental. So we've now applied our professional skepticism to this specific accounting estimate. Now, I want to ask you as students to start to think about other accounting estimates that you will find in the financial statements that will be difficult to audit. Let's take some time, analyze the financial statements, identifying those accounting estimates that may be difficult to audit, placing them in the various cycles that they lie. So for example, when we're dealing with a provision for bad debts, we know which cycle that goes into, revenue cycle. Let's try and identify those accounting estimates and pay particular attention to them because they are likely to come out. Okay, accounting estimates are likely to come out because it's such a badly audited section. The next is we want to look for the key principles that came out of this question. So what are the key principles? The key principles were, does our client understand the differences between accruals and provisions? Now let's try and apply that to a different type of setting. So does our client understand the difference between research and maintenance versus research and development versus an intangible. How are they? What is their recognition between research? When should research be expensed? When should we put it into development costs, etc.? So look at those types of things that go together: provisions and accruals, research and development. So those are the things we want to look for. Those areas, those gray areas, because those are the areas where we're going to be testing. The next thing we obviously looked at is, what is the obligation? What is the importance of obligation when we look at liabilities? Often overlooked. And then finally, what are we looking for with regard to completeness? So we want to make sure that when it comes to completeness, we understand how to test completeness, particularly with regard to our liabilities. So students, that's what we want to focus on. We want to focus on those gray areas, those difficult areas. And I want to thank you for watching. Come back next time when we'll deal more with auditing.